Hi, everyone. Sorry we're a few minutes late. Of course, we're having technical difficulties. And so we're just trying to work those out while we were, starting the hour. So thank you for joining us today. I am Melissa Calhoun. I am here, a wealth advisor with KM Investor Solutions. And today is our February webcast where we're going to be discussing things an accountant wants you to know. And before we get started, if you have any questions about any tax related things or even questions for us at CAM, please enter that in the chat box or the question box, the Q&A box down at the bottom of your screen. You'll see both of those. So feel free to submit your questions there. I'll be monitoring that and then sharing that with Kyle Flischel, who is our CPA, who will be discussing taxes with us today. He is with Murtha Flischel CPAs out of the Tampa Bay area, actually in the same office space as Sarah Contino, our wealth advisor out there, senior wealth advisor out there in Tampa. So if you have any questions, please submit those for them and I'll be monitoring, and we'll have time at the end of the conversation to answer those questions. Before we get started and dive into that, I wanted to share with you all some ways that we at CAM can help you with with tax planning. As you probably know, we are wealth advisors that are holistic in our approach to financial planning. That means we help our clients with investments, we help our clients with estate planning, retirement planning, and also tax planning. So what does that mean? We do not file taxes. We are not accountants and CPAs, so we cannot do that for you. But we're looking out into the future at how do taxes impact you in the long term. So how do assets you have now, investments you have now, or will get in the future, either from work or inheritance, how will that impact you tax-wise in the future, and what can we do about it now to help? So first example on here is real estate. If you're going to sell a property, an investment property, we can help you roll that into another property or another investment vehicle to delay taxes. Don't totally get rid of the taxes, but potentially delay them to another time. That's better for your tax income bracket. Tax-aware investments. These are important in your brokerage accounts, knowing which investments you hold and what the tax impact is on your portfolio. Self-employed clients, we can help reduce taxes through things like retirement plans, 401ks, IRA type of plans. That's one way we help self-employed clients. And then for investment reviews, we want to make sure that we're looking at capital gains and dividends and the impact they'll have if they're in a taxable account. And this goes to the next bullet of what types of accounts do your investments live in? Are they taxable, pre-tax, or tax free? And so again, maybe putting those really heavy dividend investments in one of those tax deferred or tax free accounts is a better decision. And those that are looking for income distribution, we can help those clients think about the best way to set up that income, when is it distributed, and what would the tax impact be on you in the years to come. And last but not least, for clients who have company stock, we help you think through when's the best time to sell, best time to exercise, what is the tax impact. So anyone that has ESPPs, RSUs, ISOs, non-qualified options, anything like that, please let us know and we're happy to help. These are just some ways that we help with tax planning. There are others. If you have questions about any of these or maybe something that I didn't cover, please reach out to myself or Sarah or Mark, and we'd be happy to go over some of these with you. And that's all I'm going to say about what we do for tax planning to help clients. And now we've got the stars of the show, Sarah and Kyle, and I'm going to turn it over to you guys. I will be monitoring, as I mentioned, questions. So if you have any, please pop those in and I will get to Kyle and Sarah at the end. Take it away, guys.
Thanks, Alyssa. So after a little bit of a hitch in our technology today,
you can blame me.
we were expecting to see Kyle in a different bubble, but as you can tell, we both work in the same office. I wanted to bring Kyle on board today. He's a CPA here locally. A lot of our clients work with him, and just ask him a few questions that we sort of thought a lot of our clients typically have, a lot of which we can answer, but we always thought it would be good to be able to help answer some best practices. And we're very fortunate to have him here during the kickoff to tax season. So we'll just go ahead and jump in and get started. So a lot of our clients are, if we're thinking about high income earner clients, how we usually get them coming to us asking, of course, how can I reduce my taxes? How can I save more in taxes? Can you talk to us a little bit about some ideas that you typically discuss with some of your people and what works?
Yeah, so when it comes to investments, it's investing in tax deferred or tax-free strategies such as tax exempt interest or retirement accounts that have a tax deferral component to them for high income earners and really anybody whose sole source of income is W-2. There's not a whole lot that you can do. The Tax Cuts and Jobs Act passed in 2018 removed all of what was called the unreimbursed work expenses. So W-2 employees don't have very many options. And there's three that I usually recommend to my clients who are W-2 only income earners. One is maxing out those 401ks. Most employers will offer one. There is an annual limit to what you can defer from your paycheck. And then there's a catch-up contribution if you are over 50 years old. And if you can afford to max that out, I always recommend doing that. Depending on your age and depending on your income level, we may discuss whether a traditional 401k, that is the tax deferred 401k, is a better option, or if the Roth 401k, that's the tax advantaged 401k, where you're paying tax right now, but you won't pay tax in the future. And a lot of those factors go into which one's better for which client, including, like I said, level of income and age. The second strategy that I typically will recommend is a backdoor Roth IRA contribution. This is beneficial if the client doesn't have any existing traditional IRAs. If there are traditional existing IRAs, the backdoor contribution gets a little messier. And it's a good strategy for getting money into a Roth account and letting it grow tax-free. The idea behind that is at some income levels, I believe if you're over roughly 250,000 of income, you cannot make a direct contribution to a Roth IRA. The only way to get that money into the Roth IRA is to roll it from a traditional into a Roth. You can always make a contribution to a traditional IRA. The question is whether or not that contribution is deductible on your tax return. And for higher income earners who have a retirement plan through their employer, the answer to that question is no, it is not deductible. So you're left with this IRA contribution amount that you are paying tax on, whether or not you put it into the IRA and perform the backdoor conversion. So why not get it into the Roth account and let it grow tax-free because you are already paying tax on it in the current year? And that's a really good strategy for some higher income earners who max out their 401ks and want to put a little more money into the Roth. I mentioned it gets a little messy if you have traditional IRA balances in existence, particularly IRA accounts that don't have any basis or after-tax dollars in them. It's less of a viable strategy because it won't have the intended effect. And I won't go through the details on that. But it is something to keep in mind if you have high traditional IRA balances, it may not be the best option for you. And the third option I give my W-2 employees is an HSA contribution. Depending on the type of health plan that you have, and if you meet certain requirements, you can contribute to what's called a health savings account or an HSA. I believe the maximum last year was $8,300, and this year it's $8,700 for a family plan. And I like to think of this as a quasi IRA. It's a special account that is tax-free going in. You can use that money to pay for certain qualified medical expenses. And the list of qualified medical expenses for HSA purposes is pretty broad. The only thing you really can't use it for is to pay insurance premiums. And even Amazon has a whole section of their website dedicated to HSA approved items. And as long as you use the money in that account for those approved items, it's tax-free coming out, tax-free going in, tax-free coming out. And it's a great way to pay for doctor's visits and co-pays, the dentist, if you need glasses, anything like that. And the reason I call it a quasi IRA is unlike an FSA, it is not a use it or lose it account. The wealth accumulates in that account. You can put the maximum contribution into it every year as long as you meet the health insurance requirements. And it can kind of grow. And you can even invest it as well and let that money earn money for you. A couple key differences between it and an IRA is there is a minimum age that you need to be to pull the money out of the HSA for non-medical related expenses. And that age is 65 compared to 59 and a half for traditional IRAs. If you use the money in your HSA for anything other than qualified medical expenses and you're under 65, there is a 20% penalty on the distribution, not a 10% penalty. But if you think of it as an IRA, an investment savings vehicle, invest the money, keep a little bit of it liquid in case you need to cover some medical expenses. It's just another savings account that you can generate. And if you have a big balance in that HSA and you're over 65 years old, you just treat it like a regular IRA and you can pull money out and pay tax on it or continue to use it for medical expenses when you're no longer eligible to contribute where you go on Medicare. If you are on Medicare, you are not eligible to contribute to an HSA. So those are really the three main avenues that we recommend clients who are W-2 earners to put money aside.
Awesome. I appreciate that. We'll talk a little bit about some small business and how to help with that. I know you work with a lot of folks there, but while we're staying on the W-2 folks and the earners there, we do have a lot of clients that get stock options. This is usually the time of year everybody gets their bonus, they get their stock options. So we can talk a little bit about tax impacts for, and there's a difference, obviously, ISOs, RSUs, ESPPs. I find a lot of clients don't always know the difference between them. They just know they have these stock options. And we do try to work with them as best as possible to help plan for taxes. But if you can kind of offer maybe some insight that you see on your side and maybe some tips and tricks there too.
So the first piece of advice I can give everybody is plan for it. It's coming. Your other option is to decline it all and just not make more money. And that's not obviously a viable option. So you have this income source through non-cash compensation or stock compensation. So you just want to be able to plan for it. Now with RSUs and ESPPs, you're generally issued the stock. They vest over time. I'm sorry, you're issued a grant, they vest over time. And when they vest, it all gets added to your W-2 as income. The idea behind that is you must work for the company in order to earn your right to the stock. And so because you are working, you are earning this stock compensation and it is subject to ordinary income tax rates. It is not like buying a share of stock through an investment account or on the open market. ISOs are similar. The key difference between RSUs and ISOs is one, the stock is actually issued. That's an ISO. The RSUs, the stock is not actually issued yet. You have a right to future stock at an agreed upon price. With ISOs, because the stock is actually issued, people are eligible to make what's called an 83B election. And I always recommend that the 83B election get made. So we mentioned earlier, as you work for the company and you earn these stock options, they're taxed at ordinary income rates when they fully vest and you have a right to them. With an 83B election, you are telling your employer and the IRS, hey, I want to treat this stock as if I've already earned it on the value it's worth today. So if I am given an ISO for $100 today, I can make this 83B election and say, I am going to pick up $100 of ordinary income on my tax return for this year. And then when those stocks fully vest and you have a right to sell them, you can sell the stock and the difference, your gain, is all capital gains. It's a big game changer because it's most likely going to be long-term capital gains and it's taxed at a lower rate than your ordinary income. So if you're issued ISOs, I generally recommend you make that 83B election. And most employers, when they're offering ISOs, will put an 83B election in as part of the incentive package and basically tell you you need to sign this and you should listen to them. So some of you might be thinking, well, what happens if I pick up that $100 in income and then the stock goes belly up? The company no longer exists and I never get to realize my gains. Well, that's the risk. If that's the case, then you've paid tax on that $100 that you never recognized, and you are not allowed to go back and amend your return. You must keep it on your return and you'll have paid tax on it. But in most instances, that's not the case. RSUs, ESPPs differ a little bit because the stock is never actually issued to you until it fully vests. So it's not eligible for an 83B election. However, you have a right to buy it at a reduced rate than the going market rate. Again, over the time that those shares vest, it's considered earned income for you. Your employer will add it to your W-2. And where most people get tripped up is when the RSUs fully vest, it gets added to their W-2, but there's a separate employer stock account where those shares are held. And your employer will do what's called a sell to cover. So if you vest 100 shares, your employer may sell 20 of them to cover the tax liability. They need to withhold your federal income tax withholding, your Medicare, your Social Security, and possibly your state withholding as well. And then you get a transaction form at the end of the year from the employer stock account that reports to the IRS that you sold $500 of stock. But there's no basis reported on that report. So the IRS thinks you have an additional $500 of income, when in reality, your employer has already added that $500 to your W-2. So in order to avoid paying tax on the same dollar twice, you need to have that supplemental material and make sure you're using it when reporting the stock basis on your tax return to the IRS. ESPPs will usually report some stock basis, but not the correct amount. RSUs will never report the stock basis. So the biggest trip up there is making sure you understand how much of that stock that your employer sold to cover your taxes is included on your W-2 and reporting your basis correctly so that you're not paying double tax on the same income.
I would imagine too, making sure that you can communicate with your CPA or you to be able to say, hey, I was issued these. Do you need any more information? What else can I provide? And just be a little bit proactive.
Some brokerages are very good about giving us the information that we need. It's usually buried in the very back of the tax paperwork and we have to go digging for it, but we know what we're looking for. Some brokerages don't. And we have to tell the client, this report exists, you just have to find it for us. So knowing that it exists and knowing that if you are issued RSUs, ESPPs, or ISOs, there is usually supplemental information that your accountant needs in order to prepare the taxes correctly.
Awesome. Let's move on to real estate. I think what I often get from a lot of people is not knowing, even though it's been several years, that some of the taxes have changed with basis and capital gains on primary home, but maybe if we could just review that for folks. I know a lot of people have been in their home for quite some time. And then maybe talk about the difference between that taxation versus like an investment property.
Absolutely. So we'll start with primary residences. There is a section of the tax code called Section 121 that allows for an exclusion of up to $250,000 of gain on a primary residence or $500,000 of gain if your filing status is married filing joint. And a lot of times I have people come in and they'll use their closing statement and say, I got $300,000 from the sale of my home at closing, that's my gain. And the reality is what you get at closing has nothing to do with your gain or loss. It does not factor into the calculation. Your gain is calculated by taking the sales price minus any closing costs, minus any improvements that you've made to the home during the time that you lived there, minus the original purchase price. That is your gain. If that number is less than $250,000 and you're single, head of household, or any other filing status that isn't married filing joint, you don't pay any gain on it. If that number is $500,000 or less and your filing status is married filing joint, you don't pay any tax on that gain. However, you must report it on your tax return and put the primary home exclusion code on Form 8949 to tell the IRS that you are claiming this exclusion if you received a 1099 from the title company. That 1099-S form, that's the sale of real estate, gets issued at closing. It is not a tax form that is sent after the year's ended. It comes to you as part of your closing package. So often you have to go digging through it to make sure we have that form to prepare the return correctly. Because if you don't report it on your tax return and you sell a home for $400,000 or $500,000, the IRS is just going to assume that's all ordinary income, and you're going to get a very nasty surprise from the IRS in about 18 to 24 months, claiming it as income to you and issuing you a big tax bill. There's nothing more you have to do to claim that exclusion other than report it correctly on your tax return. There is no requirement that the home proceeds be put into a new home or gifted or anything like that. And I believe that was the rule back in the 90s, but that has not been the case for at least the last 25 years. There are some caveats. It has to be your primary residence, which means you must have lived in it as your primary residence for at least 2 of the last 5 years. And you cannot have claimed this exclusion in the previous 2 years in order to claim it again. But there's an exception to that one. If the move is work related or medical related, you can claim a prorated amount of the exclusion. And then if your spouse has died in the prior 2 years before you sell that home, you are still eligible for the full $500,000 gain, even if you file a single tax return because your spouse is deceased. But the Section 121 exclusion is a great way to make sure people don't pay tax on a primary residence that they've lived in for more than 2 years. And up until the last couple of years, those exclusions haven't been a problem. I think in our first 7 years in business, 8 years in business, we had one client who was subject to tax on the sale of the primary residence because they bought a condominium in Miami in the 1970s and sold it in the late 2010s, and they had more than $250,000 of gain. We've actually seen a little bit more of it recently with the huge spike in real estate values. But most people aren't going to pay tax on the sale of their primary residence because they're going to qualify for the full exclusion. Now we can talk a little bit about rental properties. Bit of a pet peeve of mine when it comes to trying to discuss rental properties with clients, because everybody will come in and they'll say, I bought an investment property and I heard I could write everything off. And right there we have this kind of paradox. You buy an investment, and the way I relate to it is I think about a share of stock. If we're going to call it an investment property, why can't we call it a share of stock? If you're going to invest in the stock market, you buy a share of stock. And it's very analogous to that. Nobody comes into my office and says, I bought a share of stock, I want to write the whole thing off. Well, it's very similar to a real estate transaction or an investment property. You can't just write the entire cost of the property off because you bought it. And much like a share of stock, real estate will earn you income. When stock earns you income, we call it a dividend, but when real estate earns you income, we call it rent. But they're essentially the same thing. Where it differs is how we treat the rent on the tax return. I call it a special type of dividend that allows you to take certain expenses against it, such as insurance, mortgage interest, property taxes, utilities, property management fees, HOA fees, the list goes on and on. And you can deduct those amounts from your rental income, and then you'll only pay tax on what's left over. In reality, most people have a loss on rental properties because of depreciation. So I mentioned earlier, you're not allowed to write off the entire cost of the property when you purchase it, but you are allowed to write it off ratably over time. We call that depreciation. With residential rental properties, you must write the property off over 27.5 years. If it's a commercial property, you write it off over 39 years. And that ratable write-off of the cost of the property provides you a tax benefit. You've had rental income, but you don't pay tax on it because you are writing off part of the property cost against that rental income. So you are receiving this tax benefit from the cost of the property over time. The problem with that most people don't recognize is that this depreciation has to be recaptured upon sale of the property. Because you received a tax benefit, when you sell the property, you must recapture that tax benefit. Or to use assets and liabilities, you're receiving an asset when you write it off because you're saving money, it's in your pocket, and you pay the liability when you sell the property. This depreciation recapture tends to sneak up on people, and they don't realize that they have to pay that back. So if you own rental properties and you've owned them for a while and you're thinking about selling them, have a good conversation with your CPA about depreciation recapture, because you may need to set aside more of the proceeds than you think in order to cover the tax liability. So that's kind of the lifespan of the rental property. There are a few things that happen while you own the rental property, specifically relating around real estate professionals and suspended losses. We'll start with suspended losses. If your income is between $110,000 and $150,000, any loss generated by a rental activity gets phased out. And once you're over $150,000 of income, you cannot take a loss from a rental property. This tends to come as a big shock to people because they all think that they bought this rental property, they get these big losses. But remember, it's an investment, not a business. It's treated like a business, but it's an investment property. So if you have $10,000 rental income and $20,000 of expenses, you generated this net $10,000 loss. If you make over $150,000, you are not allowed to reduce all your other income by that $10,000. Instead, that loss becomes suspended, and we track it forward every single year. So let's say in the following year, you have $10,000 of net profit from your rental property. You can use the $10,000 suspended loss from the prior year and write down the next year's income, and now you have zero. But what happens if you own the property for 10 years and every year it generates a loss? The depreciation just writes down the cost of the property, and every year you have a loss. And for 10 years, you've generated $1,000 loss every year, and now you have a $10,000 capital, or excuse me, a $10,000 suspended real estate loss, and you sell the property. In the year that you sell the property, you were allowed to immediately recognize all of the suspended losses. So you would just reduce your gain on the property sale by that $10,000 in this example. So it's very important to know what your suspended losses are. For anybody who's taking meticulous notes, it gets tracked on Form 8582, or excuse me, 8552. And it's good to have that number at hand if you're thinking about selling a rental property, because it will reduce the sale of, or excuse me, the gain on the sale of that property. The other thing we come across a lot of times is what's called real estate professionals. This is a special designation, an election that you can make on the tax return that wipes out those suspended losses or those income phase out ranges. You are making an election with the IRS that says, I'm a real estate professional. I spend more than 750 hours a year in my real estate profession managing rental properties. And this is key, my primary source of income. If you own if you have a W-2 job and you're making $400,000 a year, you're going to have a very difficult time convincing the IRS that you're a real estate professional. But if you meet these designations, now you can use all of those losses every year from the rental activities to write down other income that you may have on the tax return. So if you feel like you may fit into that category, I would encourage you to talk to your tax accountant and discuss the implications of that.
That's great information. I know we're starting to run short on time. Let's just do a quick boost for small businesses, what you kind of see for like a couple of wins that small business owners can do to help, and maybe they're the best ways that they should be working with you, because we know they don't always take advantage of the help that they can get from their CPA.
The biggest thing for small business owners is know where your finances are. Too many times someone will come in at the end of the year, they'll say, here's all of my information, and we have to put together a financial statement. And that's great for tax return filing, but they weren't doing a very good job of planning throughout the year and knowing where their business stood throughout the year. And a lot of business owners will kind of run their financial health or assess their financial health of their business based on the bank account. I have money in the bank account this month, I must be doing well. And that's not a great way to run your business. If you just took a $50,000 loan and now you have $50,000 in the bank account, what happens if the lien holder calls that loan immediately and now you have nothing? So there are ways that you can track your financial health outside of the bank account, mainly through financial statements. And that's where we help a lot of our clients, putting together a balance sheet, an income statement, a statement of cash flows, helping them understand how to read and understand those statements so that they can make good financial and analytical business decisions. And one thing that I really like to stress to my clients is setting a budget. You can't run a business and have no roadmap. Someone gave me an example one time that not having a budget is like Christopher Columbus sailing for India and finding America. You just don't know where you're going if you don't have that roadmap for your business. So I always stress to clients, make sure that you have some sort of budget and track it. You want to know if you're meeting your sales goals. You want to know if you're meeting expenses. If we budget for a bottom line, a net income at the end of the year of, let's just say, $100,000. And I break that into every month, and every month I can track that. And I'll know if I'm tracking towards my net profit goal by the end of the year. And that's a much safer way to run your business. It allows you to identify issues that may pop up throughout the year much quicker than looking at after the fact financials at the end of the year prepared by your CPA for a tax return. So I would definitely strongly encourage any small business owners to have that budget and know where they want to be by the end of the year and use that roadmap. Don't get lost at sea.
That's great advice, Kyle. Well, we're just about out of time, and we may have to do a part two, perhaps when tax season is over and Kyle has a little bit more time. But this was incredible information. If we have some follow-up questions, we might ask for some of your response on them and send them to some of the attendees that we have. And I think that's all I have for today. Alyssa, do you have anything else to add to that?
You and Kyle did a great job answering a lot of the questions. One follow-up question on crypto. Any thoughts, advice, anything, doesn't have to be long, but any people should be mindful of when investing in crypto?
Just make sure, excuse me, make sure you're reporting it. The IRS requires you to report gains and losses on crypto transactions. When you trade or sell a currency that is convertible to US dollars. So the example I usually use is between Bitcoin and Ethereum. I can use my US dollars to buy Bitcoin. I can use my US dollars to buy Ethereum. But what happens if I use Bitcoin to buy Ethereum, or I sell Ethereum and get paid in Bitcoin? That's actually a reportable transaction. Even though you didn't get any dollars, it's reportable because both of those currencies are convertible to US dollars. And a lot of the crypto platforms out there, under a lot of pressure from the SEC and the government, will track all that for you, and they give you, a decent report that you can use on your tax return as well. That's one difference for crypto is it's not, even though you sell crypto and no US dollars change hands, it still can be a reportable transaction. Two, it's not subject to wash sale rules, so you can buy, sell, and trade as much crypto as you want in the same day, and you don't have to reduce your gains or reduce your losses by wash sale rules. There's one other thing. Oh, if you buy, sell, or trade crypto, make sure you answer yes to the question on the tax return. Every tax return since about 2021 has had a question that says, did you buy, sell, or trade any cryptocurrency during the year? And while I haven't seen this actually happen, the way I see this working with the IRS is if you answer no to that question and you did buy, sell, or trade any cryptocurrency, they can consider it a fraudulent return, and now there's no statute of limitations on an audit. So if you bought, sold, or traded any cryptocurrency, just make sure you answer yes to that question on the tax return.
Very good insights. I didn't know a lot of that, so thank you for sharing. And thank you for being on today, Kyle. We will get a recording of this to all of you that registered and were on today, but also who couldn't make it. And stay tuned for our March topic. Thank you. Bye.
Thank you.
Everyone.